The long-awaited rotation story may finally have some legs. Tech is lagging again today, while value and small caps are suddenly leading the market. What's going on, and is the money actually following the indices? Let's talk with Anna Paglia, Executive Vice President and Chief Business Officer for State Street Global Advisors. Anna's in charge of State Street's ETF Index and 401k business. Also joining us, ETF journalist and financial futurist, my old friend Dave Nautic, all here at the New York Stock Exchange. Anna, you're a big shot now. She is. I've known her for a long time. She's got a great new job. You run the S&P 500 index business. They report to you, all those ETFs. Is this rotation real? Is there actually money following some of these moves in small caps?
Well, first of all, I've always been a big shot.
Okay.
So thank you.
Sorry. I love that. Put me in my place pretty fast there. All right.
And yes, the money is following the trend. In the last 5 days, we have seen a huge uptick into our sector ETFs. Tilt with small cap, financials, home builders, so the money is following the trend for sure.
It seems that way. And so we're talking not just about small caps, but other things too. So we've been looking at value stocks. We all know value's been underperforming. You also oversee the S&P value ETF. That finally hit a new high recently. But is there any signs these traditional value sectors, the industrials, the energy, the materials, and maybe some of the financials, are they seeing any inflows at all? I know I'm going on to a different thing here, value over small caps, but any sign that's happening?
They are seeing positive flows. Now the question is out there: is it the value tilt or is it the cyclical investment and investor appetite for that? But definitely the numbers are there. We see positive momentum with value tilted strategies.
You know, Dave, let me bring you here. What about this great rotation? Does it have legs? And what are you watching right now?
Yeah, so for the moment, I would get a little cautious about calling this a rotation because that implies that everybody's out there selling their QQQs and selling their SPY. That's not what's happening. What we're seeing is money that, I hate to use this phrase, but we have to say it's coming in off the sidelines, that is just buying, buying, buying. They are now, for the first time in ages, buying value, buying some of these defensive sectors, buying small caps, but they haven't stopped buying the other things as well. If you look at the amazing 5 days we've had, $50 billion in flows in 5 trading sessions, it has gone into things like equal weight and to things like small cap, but it's also gone into things like SPY, which has had $11 billion in flows in 5 days as well. So I think this is money coming in from that giant bucket of money markets that we know is sitting out there. And as it's
that would be rotation.
It is rotation, but it's coming into the market, into these other sectors, these non-Mag 7 ways of playing the market. That's not the same as everybody selling off the Mag 7.
Yeah. I have 2 problems with this rotation trade, and maybe, Dave, you can comment at first. Traditionally, small cap rallies usually come off of economic bottoms and major market lows. And we have the opposite of that here. That's one problem. And it's not clear if this is just a playoff of lower interest rates and whether or not that's enough to sustain the rally. Finally, well, you know this, we have a seasonally difficult period coming up. In the middle of July through October, usually volatility usually rises and the market usually has a tough time. Does this make any sense? I'm trying to figure out whether this is real legs here.
I think there is some legs in the diversification trade. I think that's really what we're seeing more than a full-throated small caps are going to dominate rally. I think what we're seeing is a diversification trade. We're seeing flows into everything, and that to me means people are looking to get a little bit broader in their exposure, which is smart in an election year.
Yeah.
Right? Election year is one thing we do know. However, the rest of the next 6 months goes, we know it's going to have increased volatility and uncertainty about outcomes. That means diversification is your friend. Yeah.
What about, Anna, other flows? What about, say, bond funds right now? I've been looking, SPHY, this is the high yield bond fund that you oversee. It's spiking recently. Prices have been spiking here. What's going on, and is there any flow behind any of these?
It is a spiking. High yield is spiking, but we are also seeing positive flows in either fixed income ETFs like investment grade senior loans. Senior loans have had a very, very good couple of weeks or couple of months. So to us, that is a signal that investors are really getting comfortable with risk, and there will be momentum behind that. Bond funds have dominated, almost dominated the
senior
flows.
loan funds, explain how that, are those shorter duration loans? What's the length of a typical maturity for a senior loan?
They are on the short-term duration side. Our fund is active, so it is really managed to take into account some active sentiment and the best way to.
So if
really
the
manage
prices are
these
going up in
funds.
a senior loan fund, it's an indication that people think yields potentially will be lower in the near future?
Correct. That's correct. So I think that while we are all focused on the equity market, people are really looking at soft lending as something that is really in sight, and now it's becoming more and more plausible to see interest rate cuts. So this is fueling.
But to Dave's point, we keep waiting for this crowd that's parked all this money in money market funds, and my mother, who calls me up delighted that her 1-year CD is getting, 4.5%.
Yeah.
She's just
She should be
ecstatic. And this is very sticky money.
Yeah.
These people love their 4.5% bank CDs.
Yeah, but Bob, they love their 8% high yield better, right? That's the thing. I think we are seeing this sign that folks are getting more comfortable with credit risk. We haven't seen the raft of bankruptcies everybody thought we might get because rates came up and the junk market wouldn't be able to refinance. Hasn't really happened in any kind of doomsday scenario. Now we've got the prospect of falling rates, which we know is good for bond prices. If we're in a falling rate regime, people are getting more comfortable with credit, and they want more than that 4.25, 4.5 they can get in the CD right now.
Yeah,
But how sticky are those people still going to? He keeps implying that suddenly there's going to be this raft of people who are going to suddenly throw money into the stock market or even high yield. Is that they seem very sticky to me? Those people, even the people who are owning 2-year and 10-year Treasury bonds, they seem to believe that they are getting a real yield, that is inflation-adjusted yield, and the evidence is that they are at this point, and that they're comfortable with that. Is there reasons they should not be comfortable and more money should be going into other kinds of bond funds?
I agree with you. I don't think that there will be this huge wave of investors coming out of money market funds and reallocating to the stock market or to ETFs. We actually run a very successful money market fund business. And everybody has been waiting and looking at those flows, looking at this business to say, well, at some point the money is going to come out. Well, guess what? It's not, because people who invest in cash, they want cash for a reason. So some of it is defensive, some of it is going to come out and reallocate to ETFs, but most of it is sticky. I don't suspect this big wave coming out of cash.
Yeah. Well, all I can tell you is we ask people all the time, and I'm waiting for this to happen. I don't see any tidal wave happening yet. And when I look, my wife has money in various money market mutual funds at 5%. Right. They seem very happy sitting there. My wife doesn't bother me, honey, what are we going to do? Oh my God.
But net flow is net flow, right? And $50 billion in 5 days came from somewhere, right? And it probably didn't come from people just selling their mutual funds.
Yeah.
A lot of that money came from cash.
Yeah. Let's talk about flows in general. We have $411 billion coming into ETFs through the end of June. I think it's the second best first half ever. I think this is your statistic, Anna. I think what was the record? $460 billion in 2021 was that's the first half. There have been some modest flows now in small cap and value, as you've been noting to us, but most of the money, and Dave, you said this is still going into tech and big cap indices like the S&P 500. Are we going to see a record this year? What is the record for inflows?
9 something, and
900.
I think we're going to hit $1 trillion this year.
Okay.
It seems almost inevitable.
Okay, so this will be a record year, right?
I think so too. And if you look at what happened over the last 2 weeks, $411 billion was at the end of June. In the last 2 weeks, we have seen a great acceleration. We now have almost $500 billion of new money that came into the industry. So
we're definitely on track for $1 trillion year.
We are.
Okay.
Yeah.
And again, most of this, the majority of this money is still going to plain vanilla index stuff.
It's going to
and tech, XLK, which you oversee.
Right.
That's the S&P Tech ETF, still has big inflows.
That's right.
Now, if this thing really broadens out, if we actually get, look how underfunded small cap and value has been for years and years. We keep waiting for 1 year when this thing will finally happen. The academic studies, as you know, Dave, Fama French, 2-factor, 3-factor models, small cap eventually outperforms big cap, value eventually outperforms growth, but it hasn't worked very well for 15 years. Maybe 2021 it worked. Could this actually happen this year? And if that happens, wouldn't we see another an additional flow of money, perhaps coming out of the money markets into the small caps?
Yeah, I mean, certainly if we have a sustained rally in small caps, and by sustained, I mean like we have 2 or 3 months where small caps of all varieties are clearly beating the pants off of large caps, then I think you'll see a ton of money chase that performance. That always happens. It obviously shouldn't, but it does. When we're adults, we know that's how it will work. If what we're seeing instead is just a re-diversification trade, I think you would expect this to sort of bobble along a little bit here for the rest of the year.
Well, that's my question, Anna. I mean, or if you're just going to take money out of XLK and put it in small caps, that's just a rotation. But if you're taking money out of money market funds and putting it in small caps, now you're putting real money in the market.
That's why the net flow number matters, right? That's why it's worth looking at. What is the entire ETF industry capturing of new flow that's coming into the markets? And the answer is, it is the biggest money grabber right now. The ETF structure is clearly one.